Today, we're going to take a closer look at why the Canadian dollar has weakened so much recently and how this situation might be affecting the wallets and daily lives of people and businesses in Canada. First, it's important to note that a currency's value is influenced by a wide range of factors. Everything from the country's overall economic outlook and how it compares to other nations, to interest rates, import export balances, consumer spending, international investor confidence, and even global economic developments. The Canadian dollar has been on a downward trend for a while, and this decline is having both direct and indirect effects on many people's everyday lives. Let's start with the reasons behind this situation. Currency values are largely driven by supply and demand. International investors, companies, and even regular consumers need a country's currency if they want to buy its goods or services or invest there. If demand surges, the currency's value goes up. If demand drops, the currency's value slips. The troubles facing the Canadian dollar stem from a host of factors. Global investors turning toward countries like the US with stronger economic prospects, Canada's own economic and interest rate decisions, and a new global trade and political climate. When we compare the Canadian economy to that of the US, the difference becomes clear. Recently, the US economy has appeared more resilient and stable compared to Canada's. Indicators like employment rates, GDP growth, and consumer confidence generally look better south of the border. As a result, investors find US assets more attractive, which boosts demand for US dollars. A more robust US job market, higher production figures, and consumers who aren't shy about spending all contribute to a stronger economic image, reinforcing the US dollar's global standing. Interest rates are another crucial factor. They heavily influence cross-border capital flows. International investors tend to move their money to where they can get the best return. If the US offers higher or at least more stable interest rates compared to Canada, then the pull toward the US becomes hard to resist. Recently, the Bank of Canada has frequently lowered interest rates to tackle economic slowdowns. Meanwhile, the U.S. Federal Reserve has been more cautious, not rushing to cut rates unless the economy truly demands it. This contrast weakens the Canadian dollar. Investors ask themselves, if Canada's economy is slowing down and interest rates are lower, why put my money there? They head where the returns look better, often the U.S. You might wonder how this affects you if, say, you live in Canada and have no plans to travel to the US. However, a weaker Canadian dollar influences the prices of many goods and services sold within Canada. That's because Canada imports a lot of items from the US, including food products, tech devices, books, and car parts. As the Canadian dollar weakens, the cost of these imported goods goes up in Canadian dollar terms. For instance, produced at the grocery store, smartphones or computer accessories from the US can become more expensive. This puts pressure on household budgets. Travel and tourism also feel the pinch. For Canadians looking to visit the US, a weaker Canadian dollar means everything costs more once you cross the border. Let's say you've got 200 Canadian dollars set aside for a hotel room. That might only be worth $140, $145 US dollars. This difference raises the cost of accommodations, dining, and activities. As a result, many Canadians might postpone their trips, adjust their travel plans, or at least keep a closer eye on their vacation budget. On the flip side, Americans benefit. When American tourists or investors come to Canada, their stronger US dollars stretch further. Accommodations, food, transportation, and tourist attractions become more affordable for them. This can boost Canada's tourism sector. Another potential upside of a weak Canadian dollar is that Canadian exports become more competitively priced. From auto parts to lumber and energy products, Canadian goods look cheaper and more attractive to U.S. buyers. In the short term, this can help Canadian exporters increase their sales. But global trade and political uncertainties can overshadow these benefits. If, for example, the U.S. decides to impose additional tariffs or import restrictions, that cost advantage disappears in a flash. Higher taxes on imports or changes to trade agreements could quickly wipe out the gains that come from a weaker currency. Higher import prices also mean that small businesses, especially those that rely on imported goods, face rising costs. while large retail chains or multinational firms can hedge against currency fluctuations by diversifying suppliers or using financial instruments to lock in costs. Smaller family run shops, restaurants, and workshops have far fewer options. They might be forced to raise prices or accept lower profit margins. Over time, these small businesses could lose their competitive edge against bigger players, which could lead to serious challenges in the long run. If the Bank of Canada decides to cut rates more aggressively to stimulate the economy, the Canadian dollar might weaken further. If inflation rises, the bank could slam on the brakes and hike rates instead. Meanwhile, if the U.S. economy remains strong and interest rates stay relatively high, investors will keep favoring the U.S. dollar. In this unbalanced environment, the Canadian currency may continue to lose its competitive edge, leading to deeper structural issues in the long run. That's why Canada needs to maintain stable economic policies, carefully manage its import-export balance, support small businesses, and adapt to global economic trends. All this doesn't unfold in a day. Currency movements often stretch out over months or even years. The key is to understand these fluctuations and develop long-term strategies. If the Canadian dollar continues to weaken, this will affect far more than just vacation plans. It could influence everything from your grocery bill and heating costs to job opportunities and business conditions. On the other hand, attracting tourists or ramping up exports might help, but how lasting these benefits will be depends on trade policies, global risk sentiment, and geopolitical developments. I hope this comprehensive explanation helps clarify the situation. The aim here was to detail the reasons behind the Canadian dollar's decline and the many ways it impacts everyday life. These intricate economic connections show once again how global markets are woven together like a spider's web. Thanks for tuning in, and I look forward to exploring another economic topic in depth in our next video. Until then, take care.